Good evening. Welcome to this year's Rimini lecture on economics and finance. My name is Angelo Molino. I'll be chairing the session. Before Michael speaks, we have a few dignitaries who want to say a few words to the group. So let me first introduce Gianluca Spigolone, who is the president of the RCEA.
Buonasera. Come presidente del Rimini Center for Economic Analysis vi do il benvenuto a Rimini. Come sapete il centro che presiedo è un'associazione che è nata a Rimini, fortemente voluta da Luciano Chicchi, che avete ricordato questa mattina, e che trova un punto forte di riferimento nella Fondazione Cassa di Risparmio di Rimini e in Unirimini, la società che supporta l'Università di Bologna, sede di Rimini. Il centro è un'associazizione no profit, è un'associazione senza scopo di lucro che si ripropone, come certamente sapete, di favorire la ricerca economica teorica, quindi non soltanto applicata alle esigenze della quotidianità, ma anche proprio la ricerca che cerca di interpretare gli sviluppi dell'economia mondiale. Da questo punto di vista mi pare che il tema che avete posto, che è stato posto alla base della vostra conferenza, sia particolarmente significativo, in quanto proprio noi che vediamo il mondo da un paese industrializzato, con tradizioni economiche ormai mature, guardiamo con grande interesse invece alle economie in via di sviluppo, alle economie che stanno crescendo a ritmi molto, molto importanti, e quindi il capire quale potrà essere gli scenari futuri economici è fondamentale anche proprio per noi che viviamo in una parte del mondo che questi ritmi di sviluppo purtroppo li ha alle spalle da molto tempo. Non voglio farvi perdere del tempo, sono, come vi dicevo, contento che il centro da me presieduto organizzi questa manifestazione, la organizzi a Rimini dopo che vi sono state più edizioni in passato in questo scambio di ospitalità tra Rimini e il Canada. Un ultimo ringraziamento non può mancare al professor Pelloni, che come direttore scientifico ha messo in piedi appunto questa conferenza così importante. Buon lavoro.
I'd next like to introduce Luca Lambertini, who is the chair of the economics department at the University of Bologna.
Hello, everybody. Welcome to this event, in particular to Michael Spence's speech, of which I am very, very happy because it's an extraordinary occasion to have Professor Michael Spence here. And I should like to thank in particular Gigi Pelloni for having been able to attract someone like Mike at our conference. As you may know, I'm here in a dual role because I'm the head of the Department of Economics, but also one of the founding members of the Rimini Center, and I took part in almost all of the events organized by the Rimini Center here and on the other side of the Atlantic. So you can imagine how interested I am in keeping alive and very much kicking these kind of initiatives. Therefore, I will actually stop here. I don't want to take that long. I've already said almost everything I could possibly say. And so all the best for the continuation of this event here this time, and for all the remaining events and workshops and conferences in the future that the Rimini Center will surely organize here and in Canada. Thank you very much.
And I'd now like to introduce Leonardo Cagnoli, who is the president of the Uni Rimini Foundation, which is the main sponsor of the RCEA.
Professor Spence, Mr. Chairman, all of you, it gives me great pleasure and honor to welcome Professor Michael Spence in Rimini today for this international meeting of Rimini Center for Economic Analysis. It gives me an extraordinary opportunity to meet such an important economist whose studies have enriched the knowledge in a field that is extremely important for the whole world. And for this was awarded many prizes, including the Nobel Prize for Economics in 2001. The welcome even by Rimini, that for many years supports the research activity of Rimini Center for Economic Analysis, conscious of the need of independent, in-depth researches in an area as complex and sometimes influenced by partisan interest that he deals with. Professor Spence, I don't want to take more time to your lecture. Once again, welcome to Rimini and good job.
It's an honor for me to introduce Michael Spence. I'm sure that he's well known, or at least his reputation is well known to all of you, so I'll try to be brief. As I like to tell my wife, sometimes finishing early is a good thing. Anyhow, Michael is a very distinguished economist who has received the two highest awards that our profession can offer: the John Bates Clark Award in 1981 and the Nobel Prize in 2001. If you know nothing else about Michael, that tells you everything you need to know. Although he was born in the United States, he often refers to himself as an accidental American and doesn't hide his roots from Canada. Back home, people still refer to Michael as that good Canadian boy. He now spends part of the year living in Milano, and those two things and being an excellent economist makes him the trifecta choice for this evening's presenter of the Rimini Lecture in Economics and Finance. On a personal note, I want to mention that I first met Michael in the fall of 1977 when I was a skinny new graduate student arriving at Harvard University. He was my first-term micro-instructor. I think in our class awarded him the Galbraith Award for teaching, which I think played an important role in the subsequent recognition that he received from the John Bates Clark and the Nobel Prize committees. If you go to the Nobel bio that Mike supplied, you'll get a very interesting annual calendar of highlights in his professional and personal career. I did notice that 1977 was blank. Although Michael is best known for his work in signaling, which has been used to explain a variety of behaviors, everything for why so many smart students apply to Harvard as undergraduates, to why peacocks display or invest so much in their display. It was clear to us in 1977 that Michael was already intellectually restless and that he was starting to move away from pure theory. You could see that he was getting very interested in the nuts and bolts of how firms worked and the institutional details of the environments that they worked in. Restlessness led to quite a few things since I knew Mike as a graduate student. Back home, we always thought you'd show up and run for office, Mike, but that didn't happen. He did, however, have a long administrative career, first at Harvard and then at Stanford. He spent some time in the private sector trying to allocate capital well. And in 2011, wrote a book on the next convergence, which gave a kind of an optimistic twist on what we might expect for middle-income countries in the future. I gather that tonight's lecture is taking off on that book. And anyhow, join me in welcoming Professor Michael Spence.
Thanks, Angelo. Gentlemen, thank you very much for the kind words. It's fun to be here. I had no idea Canadians and Rimini had hooked up, so this is pretty exciting. Look, we have a little less than an hour. I was going to sort of use up half of it talking about growth and things related to it. That may not sound like the next convergence, but actually that's what it was about. And especially about developing countries. And then I thought I'd stop and see if we could have a conversation about this. I'm when I was teaching, Angelo didn't mention this, I learned slowly how to be effective. First thing I learned to do was listen, and the next thing I learned was I should say something stupid or outrageous or something like that, which came naturally to me. Sometime early on in the class, and then somebody'd butt in, and it turned into a conversation. It was much more engaging. I don't know if it was your class, Angelo, but one year 2 undergraduates came up who were members of the Division of Applied Math at Harvard and said, "Can we take your course?" I didn't know who they were, so I checked them out, and I was allowed to admit a small number of undergraduates, and they'd done pretty well in the applied math department. So I let them into the course. I didn't see much of them after that. But they took the exam and did rather well, and their names were Bill Gates and Steve Ballmer. Wish I'd known it at the time. I would have invested. Okay. I wrote a book that Angelo mentioned called The Next Convergence, and the story, roughly speaking, for those of you who haven't had a chance to read it, I expect that's most of you, it's based on, about a decade's worth of work in developing countries, trying to understand the growth patterns, how it works, when it fails, and so on. And I can't, cover all of that today, but I'm going to try to give you a flavor of what's going on, and then kind of look forward and ask, is this process going to continue? So, roughly speaking, real growth in the world started with the British Industrial Revolution. In England, it spread to continental Europe, and then it spilled across what Angus Madison called the European offshoots. That was Canada, the United States, Australia, and New Zealand. So I think it's a nice term. And that was about 15% of the world's population, and they experienced real growth. It was kind of breathtaking at the time, 1.5% real. Maybe continental Europe and the U.S., 2 to 2.5% in real terms. Doesn't sound very fast now. And everybody else, the other 85% of the people in the world stayed exactly where they were, except a few railways were built through their countries. And that was partly because we were organized in a colonial pattern, and colonialism, I'm not an expert on colonialism, but it was clear it had embedded asymmetries in it. And that went on for 200 years. And at the end of the 200 years, you can call divergence, even at call it 2% growth, if you carry it on for 2% at 2% for 200 years and the other people aren't growing, there's a pretty big gap that opens up. And that's the world we lived in. When we were young and went to high school, there were lots of terms for those other 85% of the people. Again, there are people who are better on tracking the etymology of this, but third world, underdeveloped, backward. Developing was a step forward, suggested something might change. Anyway, the bottom line is, after World War II, things did change, although it was almost impossible to see it at the time. And 3 things happened, I think. One was the collapse of the colonial empires, so those constraints were removed. The second was a bunch of countries decided that the disastrous policies after World War I that led to National Socialism, hyperinflation, and all kinds of things, and eventually another World War with a depression thrown into the middle, that was a terrible idea, and they set out to do something else. So there was the Marshall Plan and the GATT. And the GATT is the General Agreement on Trade and Tariffs. That's the thing that came before the WTO. And they set out deliberately to sort of create an open global economy that everybody could participate in. And the goal, clearly, if you talk to the people who were doing it at the time, was war recovery in the advanced countries, and it was sort of an accidental sort of spillover effect that the developing countries, were handed the key, or one of the important keys. And the third was technology, which had, it's not new, this is a continuous process, accelerated dramatically the ability to create what we've come to call the global economy. And slowly, falteringly, developing countries started to grow. Now, economists are famous for their forecasts, and so that knowledgeable development economists in the early post-war period, when asked which part of the world was going to be the star performer, said Africa. And and when they asked, which part of the world would really, really be in trouble, and the answer was Asia. Now that's as close to dead wrong as you can get. But there were interesting reasons for it. And I think the reasons are more interesting than the forecast, because I would have said the same thing. So I'm not being critical at all. One, the importance of natural resource wealth was way overemphasized and overestimated. Africa is easily the richest continent in terms of natural resources of any. And it turns out, actually, it gets in the way. This is why we have this term, the natural resource curse. It screws up the political economy of countries. So that was one, and that was the main reason. The other thing that I think we still haven't gotten to the bottom of, well, there's terribly important research, probably by some of you, in political economy. I view it as kind of at the forefront of what we need to do in talking about the things that I'm interested in. Sort of navigating in a complex environment with respect to growth. And that is, we didn't understand that lots of these countries that were created in the post-colonial period weren't countries. They were a bunch of people who were thrown together by people who were abandoning, that operation. So that's clearly true in Africa. And, a generation and a half with great leaders like Mandela and Nyerere and others was spent essentially creating something that we have in most countries that we're familiar with, is a sense of identity. Who are you in this with? Well, the normal answer is, you maybe a member of lots of subgroups, but you're kind of in it with your fellow citizens, and you got to have some sense of identity and what that is. And then growth started to accelerate, and there were some extraordinary high growth episodes. So there are 13 countries that grew at 7% or more in real terms for 25 years or more. Now, if you grow at 7% and double every decade for 25 years, you're doubling and then doubling again and well on your way to doubling again. That starts to make a material difference, and that is the reason why in the aggregate there's been so much poverty reduction in the world. How do countries grow at those speeds? No, we never saw that before. That's out of the range of experience. Well, it's partly the global economy. If you think of a small, relatively poor country, even if it's got a lot of people, its economy is tiny. So if it finds something that we economists call comparative advantage, there's no constraints on the demand side. You can grow and grow and grow, and you don't make a dent in that market. Or put it differently, the demand curve's not downward sloping, at least not for a long time. The only country that's ever affected the terms of trade in any significant way is China. And that's only laterally and because it's so big. It actually moves commodity prices around. It moves the relative price of manufacturing goods around and other things like that. But that never happened before. So the global economy gave you that. Think about it. Think about the reverse way. Suppose that you didn't have the global economy and all that demand, and instead you looked at domestic demand, and asked yourself, can you grow with that? Well, what's domestic demand in a country with, I don't know, maybe most of you probably don't think about this most days, but with a country of a per capita income of $400, domestic demand consists of housing, energy, and food, and more than half of it's food, because you're staying alive. That's what that economy is about. And, well, so how do you generate 7% growth, in a little tiny batch of niches, with a kind of non-tradable demand that looks like that? And the answer is you don't. You just can't. And the other thing the global economy gives you, and there's more and more attention being paid to this now, is knowledge. So that 200-year gap that built up, it wasn't just economic performance, it was knowledge, scientific knowledge, management knowledge, technological knowledge, know-how, institutional knowledge, actually. And that can be transferred relatively quickly and certainly faster than you can invent it yourself. And so this inbound knowledge transfer increased the productive potential of these economies, the ones that were organized to take advantage of it. The rest of the story, I think, is fairly simple and leads me to what I'm going to talk about next, briefly. There are a lot of features of this. There's a lot of tree roots to trip on, and if we had a semester, we could spend a lot of time on it, and some of you probably do, but we certainly don't have time with this tonight. But the single most important other variable is investment. Okay, so just take the pieces of the puzzle. You've got this gigantic global economy. It's sending knowledge and technology in. It's providing a huge market if you sort of get organized and get that right. And on the other side, thanks to Sir W. Arthur Lewis, you have underutilized resources, especially labor, sitting there in an economy that's been disconnected and in a no-growth equilibrium. So extracting that labor from its underutilized areas, traditional sectors, mainly agriculture, okay, has a very low opportunity cost, next to zero, okay? So you have a big global market. For those of you who are used to theory, this model's pretty close to linear, right? And because there aren't any sort of price effects in it, at least for a while. And of course, Arthur Lewis worried about this because that big supply of labor holds the rate of growth of wages down. And you see that in development patterns. Why? If there's 30 million people who'd love to have your job, and there's no labor market structures to get in the way of that, then you can see why the wages don't go up at the same rate that GDP does, and it actually creates a kind of inequality as an endogenous part of the process. So what's the key missing variable? Well, the answer is it's investment. And it's public and private investment, and they're complementary. And so we thought about it. There's no theory that tells you this is right that I'm aware of. Although it's consistent with what we know about capital output ratios in a wide range of developing and advanced economies. But roughly speaking, if you want to grow at 7%, you should be investing at about 30% of GDP. And the public sector investment component of that should be pretty big, like on the order of 5 to 7% of GDP. Most countries have trouble doing that. Why? Because it's very expensive in terms of current consumption to invest a third of your GDP in something that'll benefit your children and grandchildren. In fact, the most amazing thing, I think, to me, in human terms about these high growth cases is the extraordinary intertemporal choices that are embedded in them. This willingness to invest at high rates even when you're relatively poor. And it wasn't aid. And it certainly wasn't natural resource income. It's extraordinary. The Chinese investment rate when the reforms came in 1978, China was growing at very low rates, had a pretty well-educated population, had the sort of mother of all asset redistributions. The government took it all in 1949, but just horrendous economic management that went well beyond that, the Great Leap Forward and so on. When they started growing in 1978, the growth rate jumped to about 9%, and the investment rate jumped to 35%, and then rose steadily, and now it's running at 45 to 50% of GDP. 45 to 50%. Now, I'll tell you in a minute, that's both the good news and the danger in the Chinese economy, but that's kind of what it takes. And I think, to be honest with you, when we think about whether we'll ever get around to solving the problem of climate change or other aspects of sustainability, the thing we're going to have to rely on is that one of the things most of us share is some concern that our children and grandchildren are not going to live in a world with diminished opportunities. And I suspect that will eventually help us overcome all the problems and complexity and resistance. Why is that such a serious problem? Because if the story I've been telling you continues, this convergence process where the other 85% catch up with us over a century-long period, just think of the next 25 or 30 years. If China grows, if some of the others, catch up, if India, the other future economic giant, these have 1.3 and 1.2 billion people each. That's almost 40% of the world's population. They are going to be the future economic giants, unless this whole thing gets truncated. Well, we're going to triple the size of the global economy. So if some of you out there are a little worried about whether this planet can survive at a global GDP of 70 trillion, then you probably want to worry a little harder, because it's on its way to 210 or higher trillion, and over a not very long time horizon. I mean, there's some uncertainty about these growth rates, but the convergence process is pretty clear, and you don't have to do a lot of math. If you take a bunch of people who are living well, and they're 15% of the world's population, and you take a very large fraction of the remaining 85% and put them up here, you have a much bigger global economy. So where are we now? Well, there are several things to say about this, so I won't try to cover it all. Most of the GDP in the developing world is now more than 50% of the global economy. That just happened recently. It's also true that for the first time in history, more than 50% of the world's people live in cities, so we're urbanizing pretty fast. Most of the developing world that we got used to, old people like me got used to as thinking as poor, measured in GDP, not people, measured in GDP are middle income. Okay? That means they're in a range where the per capita GDP is between, say, $3,000 and $4,000 and 10 and 12, something like that. Now I'll talk to you a little bit about growth. This is a very hard transition to make. So as I mentioned to you before, we studied economies that grew at very high rates, especially in the early stages. There were 13 economies that grew at 7% or above. Of those 13, only 5 grew through the middle income, what's called to be trap. I hate the word trap, but I lost. I call it transition, and everybody else calls it trap, so you can call it trap. It's okay. Everybody else slowed down. Well, who were the high-speed transitions? Japan, Korea, Taiwanese economy, and the city-states Hong Kong and Singapore. And Malaysia and Indonesia and Brazil and a whole lot of others just slowed down. And there were other countries growing less quickly, and they slowed down as well. There's something, if you're not really into sort of understanding the moving parts in the growth, you're a statistician. You just look at it and see, well, I'm not going to understand that. Let me just look at the results. The results tell you this is really hard, okay? Because most countries slow down. The most interesting case is Brazil. After World War II, Brazil grew for 25 years or so at 7% or more. And then in the mid to late 1970s, everything went wrong. They turned inward and tried the import substitution policy. They had political economy trouble, ended up with a dictatorship. They lost macroeconomic management control and ended up with lots of bouts of hyperinflation. It was a catastrophe. And that lasted for 20 years until the administration of Henrique Cardoso, followed by Lula da Silva, and now the current government, where this, they have their ups and downs in terms of growth, but this is back to a kind of sustainable, sort of sensible-looking growth pattern. Not all the problems have gone away. But how can a country grow at 7% and then all of a sudden stop, take a quarter of a century break? Anyway, there's something hard about it. By far, the most important transition that's underway is the one in China. So China is the next test to see whether another country can grow through the middle income at high speed. And there's a huge amount at stake. The Chinese economy is about $7 trillion, about half the size of either the North American economy or the European economy. If you compare it to its predecessors, it's just way bigger. And because it's bigger, some options aren't open to it. So what are the conditions that surround this transition in China? Well, when Korea did it, the advanced countries were 70% of the global economy, very big, and growing. Now the advanced economies are 50% and not really growing hardly at all. Japan's not growing, Europe's not growing, and the United States is below potential at 2% in real terms. Second, China is a huge market share in the tradable side of the economy. I'll come back to tradable and non-tradable in a minute. And so let's call it, you know, in the things that they're in, they have 70% market share. Now, you know from companies that if you have a 70% market share and the CEO stands up and said, we're going to grow really well and the growth is going to come from expanding market share, you know he's nuts. In fact, the board will probably replace him or her fairly soon. That is not possible. So China is not going to grow by gaining market share on the tradable side. And in fact, if you go look at the data, exports are contributing next to nothing to growth in the Chinese economy. So how are they going to do this? Well, they're going to do a lot of things, including things that you're familiar with, move up the value-added chain, increase productivity, and so on. But the single most important thing that you may not have thought about is the demand side of the economy. And this is what I kind of want to leave you with in talking both about China and some of the other parts of the world. If you look at China's growth, it's been, up till now, it's been driven by very high investment rates, and very high investment rates, well, I'll come back to that, and by exports, by this external demand. Very high investment rates give you two things. One, they generate aggregate demand that employs people, generates income, and it increases the productivity of the economy as long as you're making investments with high return. So that growth pattern worked for quite a long time, but they've maxed out the export